Hi everyone, welcome back. Thank you for those who attended our first session of the day. This next session, sponsored by BlackRock, we are looking at the new Order of Collateral Management, UMR, and the use of money market funds for IM. My name is Rory Credland. I'm Head of Content here at HFM. Before we start, I'd just like to let you know that this session is being recorded and will be available on demand via our platform HFM Connect. Join for free at hfmconnect.global. Secondly, our sessions are interactive, and we do encourage you to participate by asking questions via the chat function at the bottom of your screen. I would now like to hand over to James Morrick, Managing Director of BlackRock, to introduce his fellow panelists. James.
Thank you, Rory. Hello and welcome to the HFM panel session, where we're going to talk about the exciting topic of money funds as collateral for UMR. As Rory said, by way of introduction, I'm James Morrick and I co-head the EMEA cash sales team at BlackRock, in the panel today. Before we get into introductions of the panel, we'd just like to ask the audience a poll question. So I don't know if we can bring that up. So yes, which collateral assets do you wish to post for regulatory IM? And that's cash, money market funds, government securities, corporate securities, equities or gold. While we're sort of getting the audience to do that, I just want to do a couple of housekeeping sessions. As Rory mentioned, 35 minutes today. There will be a public chat box and also a private Q&A box, so please do ask questions and we'll endeavour to get to them as quickly as possible. We also have some relevant material I think you can download via the site as well. So to introduce the panel, I have three esteemed panelists today. Firstly, Tony Ashraf, who's the Global Head of Derivative Operations at BlackRock. Secondly, I have Nick Steele, who's the Managing Director of and responsible for collateral optimization at Barclays. And finally, but by no means least, who's the founder of Margin Reform. Would you all mind just giving us a quick intro, starting with you, Tony?
Of course. Thank you, James, and good morning, everyone. So, as James said, my name is Tony Ashraf, and I run derivative operations here at BlackRock. And for me, I guess my involvement from a UMR perspective is we essentially own the adherence to UMR. And over the last year or two, we've been building out the support for initial margin. The one other element, I guess, is unique from my perspective is, as much as we own the operational processes, we also are responsible for the technology. So, making sure that Aladdin is fit for purpose when it comes to initial margin too. So looking forward to speaking to everybody today.
Thanks, Tony. Nick, do you want to go next?
Thanks very much, James, for the introduction. I hate to say that my interaction with UMR goes all the way back to 2013, when I was part of a process that helped the rules evolve with the regulators, including the whole question about which collateral would be eligible. From there, once the rules were sort of bedded down, I was very much involved in the SIM generation and creation, which then ended up moving to ISDA, and I continued to be heavily involved in the governance of the SIM model. And just because if that wasn't as much fun as it could be, I've also been running the Barclays implementation end-to-end for UMR, being the accountable exec for that for the last 7 or 8 years now, across all the different phases. So from building and validating the initial IM sort of calculations at the very beginning, all the way through to now the much more client-centric IM phases, and managing their very different approaches to collateralization.
Thanks. And Chet?
Thank you, James, for firstly inviting us to be on this panel. I'm Chet Anjosh, founder and COO of Margin Reform. We're a boutique management and IT consultancy. We've been helping firms with UMR since, like Nick, 2013 with Royal Bank of Scotland and Standard Chartered Bank, getting them compliant from phases 1 to 4. And then from phase 5, we've been helping the buy side hedge funds coming into UMR, helping them from a program set up to legal documentation, to IM calculation, to reconciliation, the full works. Myself, I'm coming up to 25 years in collateral management, focusing purely on the legal margin domain. I'm looking forward to sharing insights from the client in this panel today.
Thanks, Chetan. So just looking at the poll results that have come through here, and like the fact that we're seeing money market funds at sort of 56%, but surprisingly seeing cash so high there at 59%. So I think we're going to certainly come on to that during the course of this session. But Nick, I wanted to sort of maybe start with you about setting the scene. Why is Phase 5 so different this year? And also, if you can touch on maybe your reaction to the poll questions as well after answering that.
Yeah, thanks, James. Yeah, I feel like I've been doing this so long, I feel a bit like the grandfather of the whole UMR sort of program. And whilst people will think that Phase 5 is just a continuation of what we've already been doing for the last million years, it's actually the biggest change we've had since Phase 1. And I'd like to sort of highlight three main differences that spring to my mind as I enter into another implementation phase between now and September. The first big difference is that banks have been calculating margin requirements for their clients, mainly for hedge funds, for very many years. It's been their main mechanic to mitigate their credit risk. And they've also had to deal with all of the model management processes that go along with that. So we're used to having to deal with RWA capital models. And the regulators reused the same mechanics for the UMR model, and we were used to all of that language in that space. So we've been doing that for years, whereas some of the clients in this space, although they've been aware of initial margin, have been on the receiving end of it. They haven't had to calculate it. They haven't had to post it in a specific way. It's all been very easy, hence why people have been using cash. The next difference, which is a sort of a slight corollary, is that for the first phases, the whole concept of a threshold wasn't very interesting. We were very quickly going to use up this first free 50 million between the big banks who are posting hundreds of millions between each other. That's very different with the clients. There's a whole new logic this time. Am I going to be big enough to post margin? If so, when? Do I need to worry about getting docked with all of my clients, or just some of them, with my banks, or just some of them? And then the last one, which I think is possibly the biggest change, which is really what we want to focus on today, is about the range of collateral and collateralization methods. And despite the optionality that's been embedded in the rules since the very beginning, which the regulators offered, I won't even take credit for getting that wide range. Most of the Phase 1 to 4 banks have been very narrow in what they post to each other. We all started posting bonds, which we had available to us, and we all posted them via tri-party, which were mechanics that we were very used to. We already had in place for repo purposes and other ones. Some banks have been wide in what they'll accept from the beginning, and others are increasing. But clients are different in this respect. They're not particularly familiar with tri-party. They don't already necessarily use it for repo transactions. And so that automatic filling of margin requirement buffers is not something that they are used to, and therefore they're looking much more at the traditional third-party segging, where I just post a specific bond manually into a box for the benefit of the other person. And that has opened up all the different types of collateral which they then want to post. And sometimes that's because of the type of collateral they happen to have hanging around, and they haven't really thought about it before. And they're like, well, I've got collateral that doesn't fit that government bond piece, as we just saw in the poll. Or it's at the other end of the scale, you've got very sophisticated clients who've already decided to optimize their margin postings, existing non-reg ones, through using money market funds. And they too want to make sure that they can continue to do that, since they believe that is optimal. What's interesting anyway is that not all the clients are the same, and Chet will definitely have seen that. Different clients have got different solutions, which is not what we've had. This presents a bunch of challenges for the industry, which we haven't yet focused on because the banks haven't had to deal with it. But I think it also will present a huge range of opportunities as we move forward, and the industry for the first time properly considers the other collateral posting opportunities.
Perfect. Thanks, Nick. That's great. So I think that's good for setting the scene. I suppose, Tony, over to you maybe here, and sort of talking about how BlackRock is getting prepared for Phase 5, as we have some funds that are in scope. And what are BlackRock looking to post for initial margin?
Of course, thanks, James. And really, I guess following on from what Nick said, I mean, I guess it probably like many of the larger buy-side firms, I mean, we did start this a while ago, and where we started with was really looking at and understanding the population first and foremost. So we've been monitoring our ANA amounts for the last couple of years, to be honest, to see where we were landing, both for our internal funds as well as obviously working with our external funds where we manage on behalf of clients to make sure that we understood from the client's perspective if they were in or out of scope. So in terms of just making sure we understood the population, we spent a lot of time in that. As Nick actually said, the other thing that we did spend a lot of time on was actually optimizing our portfolios, both in terms of looking at where we could and we had an opportunity to reduce the ANA, as well as looking at that threshold and being smart about the threshold amounts. And where that actually landed for us was we did three key things. We moved where we could more of our flow from bilateral to cleared. We compressed our book, and actually we did a lot of innovations between counterparties as well, just to be smart with that 50 million threshold, as Nick was pointing out to. So once we had our population locked away, we then moved on to the model itself. We spent a lot of time debating third party versus tri-party, as I'm assuming many people are doing today. We decided to go down the tri-party route. It just made sense for BlackRock, just given, I guess, the size of our book, our sophistication, and really the three key reasons we went tri-party was to centralize the negotiation process for us, given we use so many different custodians. We wanted to create more flexibility in the module, as well as just leverage the expertise that the tri-party agents have built, given the dealers, as Nick said, went down that path. And then, importantly for us, we always knew that phase 5 for us was going to be relatively light. Phase 6 is going to be a different story. So we wanted to create scalability as we think about what comes next. Once we'd done that, we started to look at the actual available assets, and portfolio by portfolio, just look at what made sense, what was available, what we wanted to pledge. In a lot of cases, we were lucky. We did have funds that were holding the traditional assets that you would expect to be pledging. But in a lot of cases, and certainly as we look at phase 6 in particular, what we are seeing is we have funds that either don't have what we would deem as eligible, or they just really want to use cash. It's what they've done for a long time. It makes sense for them. And that's obviously leading us towards the money market fund conversation, which I know we'll touch on a little bit more. The other piece, the two things I did want to mention as well that we spent a lot of time on was we had that element of not only making sure we were adhering from an operational perspective, but our technology was fit for purpose. We decided to build our own SIM calculator within Aladdin, which I obviously give a lot of credit to Nick for in terms of getting it up and running across the industry. It was still challenging to integrate that within a system like Aladdin, so that took a lot of time. We built messaging between ourselves, tri-party agents. We had to enhance our internal governance models and controls. The other piece, kind of coming back to optimization, we've spent a lot of time on as well is looking at pre-trade intelligence. So before you're actually putting new risk on, being smart about where you're putting that. Then we moved into onboarding. And then the last piece I would also say, just to not underestimate, is actually the education element. We have spent an enormous amount of time working both internally within the operational teams, but actually across the firm to get people to understand what this phase means. As Nick pointed out, this isn't just like posting variation margin that we've done for a very long time and is well understood. This is a whole new model that we're having to develop. So that education piece was key as we've moved from being kind of project to implementation. So really, to kind of summarize, a long, certainly complex process for us. We've made our schedules as broad as we possibly can, but we obviously are seeing the needs and the demand for money market funds, which is what we're starting to build out more broadly.
Thanks, Tony. So Chetan, over to you. You've been working with numerous other buy-side firms. How have others been approaching the sort of IM challenge given this new requirement, and particularly those who are thinking about using cash?
Sure. So we've seen a number of approaches, and the reason we see a number of approaches, some of our buy-side clients have a fund administrator or an asset servicer providing them a support today for their variation margin, and they tend to go to them first for a solution. And the challenge that the fund administrators and the asset services, this is new to them as well, and they're playing catch up. So there is an approach where they can go to their kind of asset servicer and fund admin to help them get compliant. And there's that kind of educational side of things, which Tony mentioned, where UMR is very complex. And each of these clients come in with different pain points. And what we do is help them educate on what they need to do. And we're finding a lot of clients are now, in every conversation, are talking about cash, money market funds, UCITS. It's definitely picked up, in that sense. As Nick said, in phases 1 to 4, we had to keep everything tight because there's so much to do. It was new ground and we've never been through it. So if you're at phase 5, your prime broker, a number of people have been through it. So, there is an approach of using your prime broker to give you information, give you numbers, give you the ability to see the size of the problem. And what we do is then work out what is the minimum requirements. And the good news with one of the positives with COVID is that the regulators gave it some relief in the sense of acting diligently. And that act diligently is all about the threshold. And this is the 50 million threshold that each counterpart has. And what we've seen is organizations and buy sides looking at buying technology that allows them to stay below the 50 million, so they never get caught by UMR. So we are seeing a number of buy sides look at that approach. We've seen some buy sides just try to do it on their own, and it's a challenge. If you haven't been through it, you don't have the expertise. You lack the resources because you're very tight in that sense, and that's where we see the different pinch points. Also, as Tony mentioned, organisations aren't long securities, and posting securities, high quality liquid assets into a segregated IM account which you can't reuse, it's away from your balance sheet. Economically, it doesn't really make sense. And as we've seen in the poll at the beginning of this panel, 59% want to post cash, and money market funds is the equivalent to cash. It's liquid, you can move it quickly. And later on in the panel, we'll go through the challenges and opportunities around that. But we are now negotiating for one of our hedge fund clients with the dealers, money market funds. And that's a new trend that we're seeing for phase 5.
Thanks, Chetan. So just moving on here. So we've mentioned a lot about sort of money funds being a useful option here from a collateral perspective. Tony, you've done a lot of work on this from a BlackRock perspective. Do you want to just talk through quickly about some of the benefits of using money funds and why you're looking at that?
Of course, no, and just to follow on from I guess what Chetan was saying. I mean, to give it kind of context in terms of why we're focused on this and why it makes sense, and I did mention some of this before. So we either have funds that just don't have the eligible securities, and actually in certain cases are restricted in holding what we would deem as the more high quality liquid assets, and partly due to, for instance, their IMA, there may be equity only mandates, and they just can't. The other piece is obviously where we have that preference, and a good example of this is some of our levered funds, where what they're essentially doing is anything that would be potentially deemed as eligible, they're repoing that out on a daily basis, right? So they're repoing it out, they're getting cash, so they're actually sitting long cash as it is today. And in many cases, what we also have in terms of in the background is any excess cash that these funds are essentially holding, they're actually already sweeping that excess cash into money market funds anyway. So again, it's strengthening the argument and the use case when we start to look at this particular vehicle. And then when you think about the benefits, and I'm sure that the panel can certainly add to this, but from my perspective, the 3 key benefits that we were thinking about and considering was first, the liquidity element. So I think Chetan touched on this, they're really cash-like, right? You can get in and out of these funds really quickly. There's an opportunity for either same-day or even next-day redemptions. You don't get locked up. And actually, is if you compare that to, for instance, buying a bunch of treasuries, you take out that whole settlement issue that can be a challenge. And actually, the other element I should also mention is if you think about it from a cost perspective, you going out buying all these assets to hold and monitor and manage versus just investing in a money market fund, it makes sense from a pricing perspective too when you kind of do the math. The second piece that I think is really important for people to consider is diversification as well. If you invest in a money market fund, you're getting instant diversification rather than being concentrated to one or a few names, particularly important as volatility increases. And the other key piece, certainly with my operation techno hat that I think people really need to consider is just the ease as well. Think about that example I used before. If you go out and you buy a bunch of treasuries, you need to think about the settlement, the management of those assets. You need to start thinking about rolling the treasuries as you reach maturity. You also have to manage substitutions and the timing issues that come from substitutions, and therefore potential market penalties, which is just making it prohibitive and challenging for many people. So certainly that's as it stands today where I see the benefits, and as I say, I'm sure there's many others people could consider. The one other piece I did want to highlight here as well is that what is interesting to me is I think there's a lot of innovation happening in this space as well, right? And something that we are certainly interested in is the fact that as the market evolves and these assets evolve, there's a potential, for instance, for tokenization of some of these funds. And if you think about if that happens, it creates a whole new opportunity for collateral mobility as well when you think about money market funds. And while it's still emerging, it could be a real transformational change across the marketplace. So as much as I think money market funds are compelling today, I actually think in the future they're going to become even more compelling when you think about the innovation that's happening in this space too. And that's certainly why we're interested and continue to be interested.
Brilliant. Thanks, Tony. That's certainly brought that to life, and I can see what the benefits are there. I suppose what I think probably some of the audience is saying is, okay, so what do I need to think from an operational consideration? And I certainly want to ask Chet this question, but I also want to factor in, if given how many of the audience wanted to post cash, if we can just bring to life what some of the challenges will be if they do want to do cash, be it that at the custodian or the counterparty level they're wishing to post to. So I think I'll start with you, Chetan, if that's all right.
Yeah, sure. So taking that question around posting cash, within the EU regulatory technical standards, there's a concentration limit of 20% per custodian. So you're only limited to that 20%. There are some nuances depending on your client classification, but that's something to bear in mind. So you can't post all your cash. You also need to understand how you're going to, and Tony mentioned it, when you're looking at a new type of collateral, it's all about, can I price it? Can I move it? Is it legally enforceable? Are there regulatory opinions around it? And as Nick mentioned, the regulators have been really, really helpful in us in the industry, having a broad eligible collateral pool. So the operational considerations are which custodian are you going to use to segregate that initial margin? And when you decide that custodian, and I put this out quite a lot, in my view, the custodian is now the king of UMR. And the reason they're the king of UMR is because they hold that IM for you. They decide what you can and can't accept. Obviously, the legal and the regulatory opinions have to be done by you yourself, but they're the gatekeepers of that collateral. And there's pros and cons of tri-party and third-party. Whereas if you go down the tri-party route, there's less operational impact because the tri-party agents, not all of them, probably 2 out of the top 4 at the moment, really have the connectivity in the pipes to move the cash into money market funds in a quick sweep very, very quickly. So they remove that operational impact for you. So that's the consideration we see is having that custodial setup and making sure your custodian can support it, because not every single custodian can at the moment. And the reason why, if I have my custodian hat on, is because is the demand there. It's not in full yet, but it's moving there now. So we are seeing that trend. So I believe the custodians will start to provide that operational capacity and that connectivity. I don't know, Nick, if you want to add anything from your side on the sell side.
Yeah, thanks, Chetan. I mean, it's a very interesting debate, and sorry, excuse me. Some of the things that Tony said were an advantage, such as diversity, such as not having all your eggs in one basket, necessarily actually just send a little wrinkle through the UMR rules from a dealer's point of view. And just to be absolutely clear, none of these are insoluble. It's just we haven't had to do it so far. So just to give an example, if you ask a bank to accept a money market fund, although they're not having to settle it themselves, as you've said, it's nice and easy, it stays at the custodian, we still have to make sure it's reg eligible. And the way we have to do that is to look through into the underlying fund. And that creates some interesting, as I said, wrinkles. For instance, there are certain rules in jurisdictions about not accepting financials as part of the corporate bonds, if there are any. Or there are concentration rules that say you can't have more than 15% of any particular corporate group. Now, that needs to be organised so that we can easily perform those eligibility checks, or the custodians can, or some of the vendors who supply some of those services. But they're not quite there yet. And then in the US sort of type funds, that's less of an issue. They tend to be more treasury related. In the Europeans, we know the UCITS is a very wide range of collateral. So we just have to work through some of those issues with the clients to make sure that what we're accepting is easily identifiable as eligible. In addition, if you're using a sweep type fund, again, we've used them personally internally at Barclays, very effective when you don't have the right assets. But I always knew exactly which fund it was going to get swept into. So again, if I just get told that some cash is being given to somebody to sweep into an eligible fund, I need to know exactly which one it is, because I need to book that on my end to show that it's eligible. Not insurmountable, but it's the first time some of these things have come up for the banks, so we need to work through it. But I think, going to something else that Tony mentioned, money market funds have a huge applicability across the industry, but due to the nature of how they move, they've never really been opened up. We were talking about IM here, but there are opportunities in VM. Maybe tokenization helps that, and reuse and all sorts of things. Could this phase be something that unlocks that capability for a wider usage later on? I think that we've already seen that happen in some ways with the rest of the UMR program, where it's carrying other industry-wide benefits, and I think that this could be another very suitable opportunity.
Thanks, Nick. I just want to quickly touch on some of the eligibility of funds, and then we've had some questions come in from the audience. So I want to try we have 7 minutes to go. So quickly, Chetan, what types of money funds could be used should people want to be posting them?
Sure. So this is obviously focused on the EU. So if we're looking at the EU, it's UCITS from the government funds are the most likely that we're seeing. So as Nick mentioned, you need to go down into the ISINs of those UCITS. And also, one thing to think about is if your entity is a Cayman entity, think about money market funds, which are tax exempt as well. So there are a few of them out there. So there are a handful of ISINs out there that clients can use in the EU.
Brilliant. I think so. So if I touch on one of the questions, does the availability of collateral further the argument benefit of money market funds? Is collateral generally likely to get tight? So I think we sort of touched on the first part of that in terms of the utility, and as Tony mentioned, in quite a number of the funds that are impacted, the cash is already sweeping to the money market fund. If that can then be posted, there's obviously a utility aspect to that cash sweep. But I don't know if someone would like to, who would like to take, sorry, is collateral likely to get tight question there.
I don't mind. I don't mind starting on that. It's something that, with my other hat on, looking after, I don't know how many, 50, 100 billion of collateral for Barclays, it's always been the worry, but it hasn't actually turned up to be the massive stress that people had worried about from the very beginning. Bearing in mind that the banks are already posting, hundreds, well, not hundreds, probably 150 billion of margin in this space already themselves, and that's all in high quality liquid collateral, as Chetan mentioned. I think the ability to use other things such as money market funds, corporate bonds, equities, which some of us have been using since the beginning and have had optionality, other people haven't, other banks haven't chosen to do it. But I think by using those alternative forms of collateral, it's unlikely that we'll have an immediate strain. Also, we have to bear in mind that the margin takes time to build up. So this is only on new trades. So therefore, unless you're replicating your entire portfolio very regularly, which some hedge funds will be, but other more long-only type people will not, I think that I don't see immediate stress. But all of that will be benefited by using things like money market funds that clearly have much more capacity, and people are very, very comfortable with the credit risk involved.
Yeah, and I would also say this question, is collateral going to get tight? It's tight at the moment. The eligible collateral is very tight, and it's loosening. If you interpret tight being, will there be scarcity of collateral in high quality liquid assets? Potentially, yes. And that's why there is a new order of collateral. You don't have to always have, the high quality liquid assets. have some money market funds in there, spread your diversification from optimization point of view. So in the event of the stress, you can post other things, and cash is obviously very quick in a stressed environment to use.
Another question from your seat, are you seeing your hedge funds move towards cleared post UMR? I think Tony's touched on this, but does Chet Anjosh, do you want to take that one quickly?
Yeah, sure. So we are seeing hedge funds looking at clearing, not from more from a voluntary point of view, because cleared and uncleared portfolios are very closely linked, and there are risk offsets. So we are seeing clients investing in technology to look at their portfolio and moving them into the cleared world to reduce their iron footprint. So we are seeing that today.
And James, perhaps just to give a little bit more context, I mean, from our perspective at BlackRock, I mean, we've always favoured clearing. We think it, certainly from an efficiency perspective, it makes a lot of sense. The other thing that I would say as well is, as firms are looking at, obviously, the ANA and being smart about threshold, I think it continues to make sense. And the other just key point when you think about clearing as well is, at the moment we're talking about obviously money market funds and the use case of within UMR, right? But coming back to that potential tokenization element and almost money market funds being more of a collateral utility across the industry, it's conceivable in the future that money market funds could be used for Reg IM, for VM, posting your initial margin to your CCPs under the cleared model and so on. So just for people to bear in mind that as this evolves, money market funds do have the potential to be more applicable across the broader universe as well.
Makes sense. And I think one time for one final one before we wrap up. And this was one for Nick, I think. Our bank a flood of money market funds as collateral, and obviously Barclays being a counterparty that do accept money funds as collateral. Do you want to take that one?
Again, when we say a flood, from an operational point of view, provided we can prove that they're eligible, they're highly efficient for us because they're very, very good quality. All the things that Tony said that were great for the investor in the money market funds are great for the receiver from a diversity point of view, credit risk point of view. So typically the banks are fine having those kind of that sort of collateral. Where it gets more interesting, and we just need to do a little bit more work, is if there are the odd reg wrinkles, or if there are certain funds which, if they were slightly different structure, would just make it that much easier to get over the hurdles. But as I said before, and I've said again, these are not insurmountable. They just require a little bit of development, which maybe money market funds will benefit from in the much wider context that Tony already alluded to.
Thanks, Nick. So to summarise, I think this has been a great session, and I think we wanted to sort of have some key takeaways in terms of money funds being a viable option for initial margin and should be considered. I think if you're thinking about using cash, there will be certain issues which we've highlighted today. And so I think that's at the custodian or the counterparty level. And I think, but a good number of them will allow for money funds as a viable alternative. So you should certainly think about that, or giving yourself the optionality of that as a collateral source from adding it to your collateral schedule. So I think, it's been a great session. I'd like to thank you all for listening. And I think we could have gone on and on for a bit longer. And I'd like to thank the panelists for taking part. So there is a community chat box. You can go in there and provide, get in touch with us if you want to ask further questions. There were some other questions to answer. And so please do that. And have a great day. And I'll hand it back over to Rory.
Thank you, James. Thank you for that. Thank you all panelists. Thank you to BlackRock for sponsoring that session. So yeah, up next we have ESG, regulation rankings and returns. Stay tuned. Go and grab a cup of tea, and we'll see you back in 5.